In this video, let's talk about how I started my passive investing journey with Australian low-cost index funds. I made this video to be as simple as possible, so if you do learn something new, consider gently smashing that like button right there. But if there are anything that's confusing, just let me know in the comment section below. And before we start, since I'm not a professional, this video is not financial advice or recommendation to do anything. It's just general information for entertainment purposes only. If you do need help with investing, make sure you go see a licensed professional. So, without further ado, let's go! Okay, since this topic is so well covered, I've summarized my process into 5 main steps, and I'll share my thinking around why I went down a particular index fund route. Now, there is a minor difference between ETFs and index funds. ETFs are bought and sold like a stock through a stock exchange, hence why the name exchange traded funds. Whereas index funds are not traded over a stock exchange, and it might have a higher minimum investment amount, and the prices are calculated differently as well. Alright, this brings me to the first step of my process, and that's deciding an amount that I am going to invest in every single month.
If you've been following me for a while, I'm sorry if I'm nagging.
The truth is, no one knows whether the market is going to go up, down, or freaking sideways. So naturally, when I started the passive investing side of my portfolio, I decided an amount that I was comfortable investing in every single month, and I invested that no matter the times are good or bad. But that amount you decide, it's got to be a commitment. And to make sure I don't accidentally buy some Jordans, I automatically route that money into my brokerage account so that I am somewhat forced to invest that money. Trust me, I used to have so many bad spending habits. I'll talk more about that in my How to Retire by 35 video. That consistency of investing regularly helped me ignore the price fluctuations. And not only did I sleep really well, the effort compounded over time. Now, the second step of my process is choosing a brokerage that I'm comfortable with. There are so many brokerage choices nowadays, and I kept things very simple for myself. I chose something that was affordable, easy to use, and I own the shares outright. As many of you know, I use CMC markets for a lot of my Aussie share investing and stake for my US share investing. Hashtag not sponsored. I just find them really easy to use, and it might be a little bit different for you. But I have made a full video on different brokerages, and if you're interested in that, I left the link in the description box below. And the third step is I decided what I value the most in investing. That is, do you value income, share price growth, or a bit of both? Of course, there is also ethical investing to consider as well. I won't talk too much about ethical investing in this video since I really think it deserves its own video. More importantly, I dug inside the index funds to see if I like what's inside. And if I didn't, I just went out to research more until I find something that I like what's inside. Now, when I say income, I'm referring to dividends. And dividends in Australia tends to be quarterly, half yearly, or even yearly. And depending on where you receive those dividends, it could bump up your taxable income and therefore a higher amount of taxes. On the other hand, share price growth won't change your taxable income, but those gains are not real until you sell those shares. Now, the tax implications are very different for everyone. I personally work with a tax accountant to help me out with this. If you do need help with taxation side of things, make sure you go speak to a licensed professional. Because honestly, a good tax accountant just helped me sleep that much better at night. All of the above are things I considered when I started my investing journey. And because I couldn't really decide, I wanted a bit of dividends and also a bit of share price growth. Which brings me to the fourth step of my process, and that's researching index funds that aligns with your values. Now, given that I wanted a bit of income and also share price growth, I went out and researched a list of low-cost index funds that fulfills my values. Before I continue, I want to remind you that this is just my own thought process and not financial advice or recommendation to do anything. And just so you know, management fees are taken out of the fund at the end of the year. You don't actually get a bill sent to you to pay those fees. When I started the passive investing side of my portfolio, there wasn't all these choices with esports, cybersecurity, etc. It was actually really vanilla. And frankly, the passive investing side of my portfolio is built on the most boring, vanilla index funds. Here are the low-cost index funds I researched. The statistics in front of you are the most up-to-date version that I could find from the ASX, BlackRock, and Vanguard. But let me give a quick overview of what each of them are. VAS is an ETF that tracks the top 300 companies in Australia, VTS tracks the entire US market, IVV tracks the top 500 companies in the US, and VEU tracks some of the world's largest companies except for US. What's really interesting is that Vanguard and BlackRock will generally report their dividend yield and historical returns together. The returns reported is total returns, so that would include dividend paid as well. The historical returns report tends to be total returns, so that will include dividends paid. But dividend yield reported is just a snapshot of the current reality. It could be higher or lower in the past. The question is, how much dividends will I actually get paid? And also, if I reinvest the dividends yielded over a 5-year period, will that change the total returns at all? Those two questions are additional layers of due diligence I've learned to double check when I research ETFs or index funds to invest in. So to find out, I created a sample portfolio in my ShareSite account, and I hypothetically invested $10,000 in each of the ETFs 5 years ago in 2015, just to see how much dividends I would have got paid and how dividend reinvestment would change my total returns. Straight away with dividends, it shouldn't be a surprise that VAS is paying the most dividends out of the 4 ETFs. And that's just because majority of our biggest companies in the ASX are in the mature industries. The rest of the ETFs, especially IVV and VTS, tends to lean more towards capital appreciation. And that makes sense since majority of the biggest companies in the US are tech companies. Now only VAS have a track record of dividend reinvestment. So to turn dividend reinvestment on, click into the position, just go to holding settings and turn on auto dividend reinvestment. I've already turned it on just so that I can see what the total returns are. And the total returns for dividend reinvestment is about 12%. And over the last 5 years, it has paid approximately 6% in dividends. If we just go back to the spreadsheet and look at the 5-year return of VAS, so the reality is actually quite different if I reinvest the dividends. And if you want to try using ShareSite to do due diligence, I have left the link in the description box below, so feel free to help yourself. It's important to note that past performance is not indicative of what's going to happen in the future. The only reason BlackRock's IOO is not on this list, and IOO tracks the top 100 biggest companies in the world, is because of the management fees. I personally would like US exposure since I'm a tech nerd and my background is in startups, so I love learning about technology companies. In Australia, majority of our biggest companies are in industrial, mining, or even banks. Only recently in the last few years, we've had some real contenders in the tech space, like for example Xero, Altium, and Appen. So when I took a closer look into ASX 300, there wasn't that many companies that got me excited, which leaves me with VTS and IVV. Since IVV tracks the top 500 companies in the US, and I wanted more diversification, I ended up going with VTS. As it stands, approximately 11% of my portfolio is dedicated towards VTS. And by the way, VTS is domiciled in the US, which means that every 3 years or so, I have to fill in a W-8 Ben form. With IVV, it's domiciled in Australia, so you don't have to fill in any forms. And the fifth and final step of my process is to stay consistent. As I increase my income, I increase the amount I invested regularly. Many of you have asked how I grew my portfolio so quickly. And to tell you the truth, I live like I'm broke. If you can't already tell, my wardrobe is full of black t-shirts. And that's why in all of my videos, I'm wearing a black t-shirt. I do have a few white t-shirts if I ever need to switch things up. But frankly, a lot of the growth in my portfolio is through my own contribution. Did the market crash in 2020 help? Definitely. I took the opportunity and I basically invested everything that I possibly could. In my How to Retire by 35 video, I'll share more about my income sources and how I've built them over time. It took a lot of hard work. Studying, sleepless nights. I'll share as many practical things as possible so that you can draw inspiration from it. And that's essentially my process on how I started my passive investing journey with Australian low-cost index funds. So, thank you so much for watching this video all the way to the end. If you would like some additional content pieces, not to mention be part of my fortnightly Q&A and my Discord server, consider supporting this channel via Patreon. Nevertheless, if you have learned something new, consider gently smashing that like button, subscribe to my channel and click onto the bell so that when I release future videos, you'll be the first one to know. If you're not sick of me yet and are in the mood for an additional video, I've left something on the screen that I think you'd really enjoy. Until next time, my name is David. Otto will always do the honors and see you very, very soon.